In particular, given the current interest rate environment, the metrics of buy versus rent are tilted very heavily in most jurisdictions, most MSAs to rent. Hence, we expect this demand to sustain itself through even a recessionary cycle.
Joining me today is Tom Capasse, Chairman and CEO of Ready Capital Corporation. So Tom, a highlight of the first quarter was Ready Capital's merger agreement with Broadmark Realty Capital. What do you expect the transaction to be able to deliver?
Yes, we're very excited about this transaction. It's transformative for the company. It's our 8th acquisition in 6 years since going public in 2016. And Broadmark provides both financial and strategic benefits. The financial benefits are a 1/3 increase in our capital base, and given that Broadmark is unlevered, a 1.5 times reduction in our leverage, as well as $250 million of liquidity in a point in the credit cycle where we've seen opportunities equal to where we were just after the GFC. And the third is that, most importantly, that the transaction is accretive probably starting at the end of this year.
And why has Ready Capital gravitated toward affordable and middle-income housing, and what opportunities do you see there?
Yeah, post the GFC, there's been a epic dislocation in terms of the demand for housing and the availability of housing units, in particular in the middle of the pack in terms of middle income and affordable housing. So we've purposely directed our direct lending strategy, which began in 2012, at that sector, and we provide sponsors in that market full life cycle, full property life cycle financing from construction to takeout in the stabilizer agency market. But what we like about that market is the fundamentals. In particular, given the current interest rate environment, the metrics of buy versus rent are tilted very heavily in most jurisdictions, most MSAs to rent. Hence, we expect this demand to sustain itself through even a recessionary cycle.
And does Ready Capital expect to invest in distressed portfolios that might emerge as a result of recent market turbulence?
Yes, that's one of the main differentiating factors of Ready Capital versus other single pony mortgage REITs, which just do direct bridge lending. The external manager has extensive resources with respect to the resolution and acquisition of non-performing and so-called scratch and dent, in particular small balance commercial portfolios. Post the GFC, we were, if not the largest, one of the top 3 acquirers of small balance commercial loans from banks, acquiring $5 or $6 billion and resolving over 5,000 units. So today, as we enter the current credit cycle, what we're seeing today is a similar but different opportunity. I mean, one metric I saw the other day was the Fed published guidance in 2006 as to what banks are scored based on their so-called CAMEL rating for commercial real estate exposure. It's a number of metrics like having CRE exposure over 100% of your Tier 1 capital. So the banks that met that criteria were 300 maybe about 6-7 years ago. Today it's 700. And that's because regional banks in particular have entered into the market post the GFC, and today account for about 70% of commercial real estate lending in the United States. So with that and the current banking crisis, banks are unable to sell their bond portfolios to meet deposit outflows because they're underwater. So they're now turning to their loan portfolios, both performing and non-performing, and we're already seeing about I'd say a 3x increase in inquiries versus 22 from our trading desk. So we expect to see a fair amount of the liquidity that's being raised through the Broadmark transaction will be invested in these distressed or performing asset sales by commercial banks.